Welcome to This Explainer. Okay, today I'm going to be stepping into the role of your professional technical analyst. And together, we're going to learn exactly how to cut through all that daily market noise and really confidently identify structural trading patterns. I mean, if you've ever looked at a price chart and just felt completely overwhelmed by the sheer chaos of it all, you are absolutely in the right place. We're going to decode that chaos right now.
So let's kick things off with a core philosophy, right? Because every single shape we see on a chart, it's just a permanent record of buyers and sellers battling it out for control. A chart pattern isn't just random math. No, it's a literal footprint of human emotion. It's this visual representation of pure supply, demand, fear, and greed playing out right there in real time. And hey, fun fact, this psychological approach, not new at all. Charting dates all the way back to 18th century Japanese rice traders. They actually invented candlesticks specifically to track trader emotion over raw supply and demand. They realized way back then that human psychology moves markets just as much as crop yields do. How crazy is that?
All right, here's our syllabus for today. First up, chart basics and core levels. Then, spotting continuation patterns. Number 3, identifying reversal patterns. And finally, strategy and risk management. Let's get right into it. Section 1, chart basics and core levels. Because before we can identify the really complex patterns, we absolutely have to understand how we're actually looking at the market data itself. You know, when you're staring at a chaotic market, it is incredibly easy to get lost in those rapid price swings. It's like you can easily suffer from paralysis by analysis, where conflicting, frantic signals leave you totally unable to make a clear decision. And that brings us to a really crucial structural choice in how we process our data. Now, just look at how switching to a simple line chart completely smooths out that intraday volatility. Don't get me wrong, candlesticks are fantastic. They show the open, high, low, and close. But for a structural analyst, sometimes that just creates massive information overload. Algorithms and day traders create all that intraday noise, the wicks and the shadows. But the closing price? That is where the major institutions settle their bets. By connecting only the closing prices, a line chart basically strips away all that retail noise and makes those underlying macro structural patterns just glaringly obvious. It's honestly a fantastic tool for training your eye to see the real trend. Ultimately, everything boils down to two key psychological levels: support and resistance. Think of support as the floor, where buyers step in because they see overwhelming value. And resistance, that's the ceiling, where sellers aggressively take over because they think the price has just gone way too high. Kind of imagine a tennis match, right? The ball is constantly being rallied back and forth between the floor and the ceiling. Literally, every pattern we're going to discuss today is simply a visual mapping of the tension in that exact tennis match. Moving on to Section 2, spotting continuation patterns. These are those vital pauses before a trend resumes its original direction. Okay, so triangles give us this magnificent view of energy compression. Take the ascending triangle. This forms when you have a flat ceiling of resistance, but a rising support line. So why does this matter? Well, it shows buyers are becoming increasingly aggressive. They're willing to step in and buy at higher and higher prices, totally refusing to wait for a deep dip and just constantly pressuring that flat ceiling until it shatters. It is a highly bullish setup. On the flip side, you've got the descending triangle. That shows sellers completely dominating the floor, pressing lower and lower highs against flat support until the floor ultimately gives way and the price breaks down. And then we have the absolute classic bullish continuation, the cup and handle. So after a prior strong uptrend, the market takes a well-deserved breath. It forms this rounded, U-shaped consolidation. That's your cup. And it shows that massive selling pressure is gently diminishing. Then we see a slight downward drift, which we call the handle. Now, this handle is a fascinating psychological moment. It acts as a final shakeout. Early, impatient buyers get super frustrated by the stall and just sell their positions. And that allows the larger institutions to swoop right in and scoop up the remaining supply right before a powerful breakout launches the price straight above resistance. But what happens when the trend exhausts itself entirely? Well, that brings us to Section 3, identifying reversal patterns, the major shifts in market direction. I want you to pay close attention to the volume drop on the second peak of a double top. This M-shaped formation frequently appears at the exhausted, breathless end of a really long bull market. When that second peak forms on significantly lower volume, that is the market screaming at you that demand is completely drying up at resistance. I mean, as the old trading maxim goes, price can lie, but volume is the truth. The buyers are just tapped out. Once the price breaks down to the middle neckline of that M, the reversal is structurally confirmed. Conversely, we have the double bottom. This W shape forms when massive supply finally exhausts itself, creating a solid floor where buyers decisively take control. But word of warning, W shapes are notoriously tricky to trade because of frequent fakeouts. The crucial battleground here is actually the middle peak of the W. Breaking above that metal neckline is the ultimate proof that the sellers have truly given up. When that neckline shatters, boom, it signals a powerful reversal of the previous downtrend and a brand new bull run is born. Now, unlike sharp, sudden reversals, the rounding bottom plays out over a much longer time frame. Think of this pattern kind of like turning a massive cruise ship around in the middle of the ocean. It is a slow, steady transfer of power. Following a prolonged, just grueling downtrend, the price carves out this really smooth bull shape. It's a gradual, almost invisible shift in psychology from eager sellers back to confident buyers. And it eventually culminates in a massive neckline breakout and a highly reliable, long-term bullish trend reversal. Wedges give us another perfect visual of energy compression, but man, they are incredibly counterintuitive. Honestly, it's why they trap so many beginners. A falling wedge slants downward with a contracting, tightening range. It happens deep in a downtrend, showing that downward momentum is actually losing steam and squeezing the price until it literally has nowhere to go but to explode upward. So yeah, a falling wedge is shockingly bullish. The rising wedge does the exact opposite. It slants upward, but the contracting range warns us that buying power is secretly weakening under the surface, foreshadowing a pretty steep bearish drop. Okay, so recognizing these shapes is only half the battle. Now we actually have to apply the rules. Section 4, Strategy and Risk Management. This is all about professional execution. To execute professionally, you must calculate your profit zone objectively, completely removing greed from the equation. So how do we do that mathematically? Well, you simply measure the depth of your pattern. For instance, take the distance from the very lowest point of your cup, or your rounding bottom, straight up to the resistance line. Then you take that exact depth measurement and add it to your breakout point. It's that simple. This gives you a clear, structurally sound, mathematical target price for exactly where to take your profits. But listen, to survive in the markets long term, you need strict, unbending execution rules. First up, always wait for the daily or hourly candle to fully close. Why? Because intraday spikes are specifically designed by larger players to trap impatient amateurs. Second, confirm your breakouts by looking for a massive surge in buying volume. Again, remember, volume is the truth. Third, use moving averages as a filter to ensure the broader market tide is actually at your back rather than fighting the current. And lastly, always protect your capital by setting a hard stop loss just below the pattern's handle or neckline. Literally, no exceptions. So I'll leave you with this thought. If these chart patterns are simply human psychology, if they're just visual representations of mass fear, greed, supply and demand playing out over and over again through centuries of trading, what is your chart trying to tell you right now? I highly encourage you to open up your charts today, switch between the line and candlestick views, map out those tennis court floors and ceilings. The market is constantly speaking to us. We just have to learn its language.